I invest $2,100 every month across my ISA and pension accounts. This approach has led me to build a 120k portfolio. And in this video, we're going to go through exactly what I invest in and why I invest in the things that I do. I often get comments in my videos of why did you invest in this? Why don't you put money into this investment? So hopefully today we'll answer all the key questions around this, around my investing strategy. If you're new here, I'm on a journey to build up my portfolio to the point where I'm financially free. And I'm sharing the whole journey on this channel, all the highs, all the lows, and everything in between. So if this sounds good to you, then I greatly appreciate subscribe. As always, I need to say that this is not financial advice, and please do your own research. So let's get straight into it and kick off by going through what I invest in. Then in the second part of the video, we'll go through why I invest in these things. You may also be thinking, how the hell can you afford to put away $2,100 every month, as it is a very large sum of money? I have a separate video going through how I'm able to do this. You'll be able to find it up here. But for this video, let's talk about where the money goes. I split the $2,100 across 3 platforms: InvestEngine and Trading212 for my ISAs and Aviva for my pension. So let's go through these individually, and let's start with InvestEngine. Here I invest $1,500 per month into 4 ETFs. 85% of that, so £1,275, goes into a world fund, the HSBC MSCI World. Then the remaining 15% is split evenly between 3 other ETFs. So £75 each goes into a gold fund, small cap fund, and MSCI Europe fund. This portfolio is very focused on global fund investing, and it's a similar story for my pension account with Aviva. Here I invest £544.62 each month, made up of my own and my employer contributions. 90% of that, equivalent to £490, goes into a world fund, and 10%, so around £54, goes into an emerging markets fund. So again here, the focus is on global fund investing. However, my Trading212 portfolio is the odd one out, as here I invest £100 a month into 2 individual stocks, not into any kind of fund. I invest into Alphabet and Microsoft. I'm not always consistent here in terms of the amount I allocate to each of those stocks. Sometimes I allocate more to Microsoft, other times more to Alphabet. But overall, it usually works out £100 between them on average. Now we know what I invest in, let's explain why I invest this way and why these specific investments. With investing, there's usually 2 main approaches. Firstly, the alpha approach, the active approach, where you attempt to beat the market return. For example, through picking individual stocks or through trying to time the market. Then there's the beta approach, the passive approach, where you simply try to match the market return, usually through index investing. I'm definitely on the beta side with my portfolio, in that I'm trying to simply match the long-term average market return through mainly investing in global funds. In fact, of the £2,144 I invest on a monthly basis, 91% of this, so £1,969, goes into funds which track global indexes. You may ask the question, why are you not trying to beat the market? As surely we want as high a return as possible. And that's true, I'd love a higher return than the market average, but it's incredibly hard to beat the market, and it's quite high risk unless you really know what you're doing. So if you're really experienced, or if you've got some kind of unfair advantage, but even then it's incredibly hard. I found this out when I started investing. As when I started investing, I thought I could pick some individual stocks, I thought they would go to the moon, and I thought I would make a very good return. But it didn't pan out like this. Instead, I ended up losing money on my individual stock picks, as I didn't have the expertise to pick individual stocks, and I was essentially gambling. Even the experts, the active fund managers, struggle to consistently beat the market over the long term. For example, data from S&P Global found that 72% of US large cap actively managed funds underperformed the passive S&P 500 index over a 1-year period. And over a 5-year period, it's even worse, with 86% underperforming. So this data shows that it's very hard to beat the market, especially over longer time periods. And for this reason, I now focus my approach on simply trying to match the average market return through holding global funds and holding them over the long term. You may be thinking, why don't you just focus on the American stock market and hold an S&P 500 fund? And this sounds very valid. There's fair arguments behind this, as the biggest companies in the world are American, and the American stock market has outperformed the wider global stock market over the last 15 years, and it's done so with quite a big gap. However, this hasn't always been the case, as US and international stock outperformance tends to move in cycles, and there's been plenty of cycles of international outperformance in the past. In fact, since 1975, the outperformance cycle for US versus international stocks has lasted an average of 8 years. We're currently 14.6 years into the current cycle of US outperformance, suggesting that we're overdue an international period of dominance. Now, of course, the US may continue to dominate, and many people, including many analysts, do feel this way. But I myself, I don't want to take that risk that the US doesn't continue to dominate. So instead, I focus on global funds, which are unbiased and heavily diversified across different countries, regions, sectors, and even company sizes. I still get heavy exposure to the US, as the funds I invest in are market weighted, so the bigger the company size, the more weighting I'll have towards them. And the US, of course, as of today, has the biggest companies in the world, so the world funds I invest in are heavily skewed to the US. But let's say that changes. Let's say these mega US companies decline and European companies go on a big run and start becoming bigger and bigger and bigger. In this case, the world funds would automatically rebalance, evolve, giving more exposure to European companies and less exposure to these US companies. So these world funds simply follow the money no matter where it goes. If the US does continue to dominate, I won't get as big returns as I would have if I just invested in an S&P 500 fund, but I'm okay with that, as I'm taking a lower risk approach in my view, and this works for me. Now we know my overall approach, let's go through why I chose the specific global funds I did. The main reason I chose the core world funds with my Aviva and InvestEngine portfolios is the cost, the total expense ratio. These are two of the lowest cost world funds about on their respective platforms. For example, the HSBC MSCI World comes in at just a 0.15% total expense ratio. This was the cheapest world fund available when I begun my InvestEngine portfolio. Since then, InvestEngine have added cheaper world funds, and I will likely move to one of these cheaper funds at some point to reduce costs. When I do this, I'll also move to an accumulating fund, as currently I'm using a distributing version, which isn't ideal. Nonetheless, both funds I use on InvestEngine and Aviva are relatively cheap compared to the broader fund market, are large in size in terms of assets under management, and are from well-regarded fund providers. And all of this ticks the key criteria I have for world funds. In terms of other funds, I added in a small cap fund and an emerging market fund because of the limitations of a world fund in not enabling me to get all the exposure I want across the globe. These are called world funds, but they don't actually cover small cap companies, they only cover medium and large cap, and they also don't cover the emerging markets. So to give me that full global exposure, I invest in these funds. There's plenty of small cap and emerging market funds about, but I chose these specific ones as they were extremely low cost. On top of these funds, I also invest in a Europe fund. This is a bit of an active approach, as my world fund already has exposure to Europe. However, these world funds have become heavily US focused. So earlier this year, I decided to invest a small additional amount in a low-cost Europe fund to actively reduce my exposure to the US. Although this technically is against my passive approach, it does follow my overall investing strategy in being globally diversified to reduce risk. And overall, between all of the ETFs we just went through, I invest 91% of my monthly contribution. The remaining 9% doesn't follow the global approach. I invest £75 per month in a gold fund. This is a hedge to my equity funds, as gold typically is a safe haven when equities go down, and gold more generally tends to move in a different direction to equities. So the aim with this gold fund is to provide a small exposure to a different asset to smooth out the long-term cycles of my investment portfolio. However, at the moment we're actually in unique circumstances in that both gold and equities are reaching all-time highs, and this gold fund has surprisingly been my best performing fund in my ISA. The final £100 I invest every month goes into individual stocks in Alphabet and Microsoft. And this again does go against my wider passive global approach and is essentially stock picking. But it only forms a very small percentage of my contributions, less than 5% of my monthly contribution. At this amount, I'm happy to take a little bit more risk, as it simply doesn't impact too much my overall portfolio performance. I chose Microsoft and Alphabet specifically as the two companies I wanted to invest in, as I do believe in their long-term prospects. So that's how I invest $2,100 every month across my ISA and pension accounts. My approach is very much focused on global funds, with a dash of gold and Alphabet and Microsoft on top. This is the approach I've chosen, and if you're thinking about starting an investing journey, then please do your own research. I'm not a financial advisor. If you enjoyed this video, then I'd greatly appreciate a like, and if you want to leave a comment about anything, can be good, can be bad, you may contend something about my strategy, then please also drop a comment. I'm always welcome to friendly conversation back and forth in the comment section. I'm on a learning journey, so if you can help me learn as well as the others watching this video, then it's a win-win. Thanks for watching.